It's a red headline. Well done. The market's business, 1.159 billion, up from 977. What was the standout in the market's business? Let's talk to the market.
Well, I think obviously we're very pleased with the results of the third quarter. This is the second clean quarter for the bank. We have no legacy issues. Profits were up some 40%. We generated, for the second quarter in a row, earnings over £1 billion clean. So that's a demonstration that the strategy of the bank is, I think, well on course. In terms of your question around the markets business, on a dollar basis, our markets revenue in the third quarter was up 19% year over year. That's the best performance of any bank to report thus far in the third quarter. We have gained market share in our investment banking market revenues 4 quarters in a row now, which I think demonstrates the return on the investments that we've made in that business. Let's not lose sight. Barclays UK also had a great quarter. It was positive jaws, positive earnings of some £2 billion pre-tax. And so very good performance there. Return on tangible equity in Barclays UK was over 18%. This is also the third quarter in a row that Barclays, as a group, generated a double-digit return on tangible equity, which is what our goal is.
Jes, good morning. It's Naira in London. Talk to us about equities trading. There were quite high expectations of this in the market. So tell us how that performed.
You know, we've been doing well all year long on the equities trading side, from cash equities to trading what's called flow derivatives. We are launching new electronic trading platforms across the equities business over the course of this year. That's had a strong impact. We've got a new management team in place for that business, and that's doing quite well. So we've done well from credit to equities to rates, currencies. Again, we were very, very pleased with our markets performance, gaining market share by quite some margin in the third quarter.
Jes, this will naturally lead the market to a couple of questions. So let's clear the decks on a few of them. Obviously, Bramson and Sherbon. Does this strengthen your hand in pushing back at Bramson in terms of his call for what? In terms of delivering better returns? Can you slap that activist investor down with these kind of numbers?
Well, again, you know, we obviously look at the profitability of the overall group. We generated an 11% return on capital in the first quarter, a 12% return on capital in the second quarter, and now a 10% plus return on capital in the third quarter. Part of that, you know, it's been across the businesses. You know, our consumer business in the UK has done very well. Our consumer business in the US has done very well. Our corporate business has done quite well, and the investment bank has done well. And as we've commented on before, the markets business in investment banking, i.e. trading currencies, rates, equities, etc., has generated a double-digit return over the last 9 months, and that's what you want to do. It's higher than the cost of capital. So we like the diversification of our model. We like the business mix that we have, and obviously we're enjoying the profitability that we're generating.
Jes, Edward Bramson, though, is supposed to be updating investors this month. He also said in late August that the board is recognizing that your strategy is unsuccessful. What conversations have you had with him since the last quarter?
Well, I think the board's very happy with the results of the third quarter, and I don't think anyone would say that what we were doing is not successful. In fact, I think it's quite successful. We will be meeting with Ed, I think, in the next couple of weeks. It will be the second time that I've met him. I look forward to his ideas and what he is suggesting. He has not expressed them to us yet, but we're focused on our transatlantic consumer and wholesale bank strategy. It's delivering a double-digit return for the 9 months. It's actually the second most profitable 9-month period in the modern history of the bank. So we think it's generating the returns that we expect, and we look forward to having our conversation with Mr. Bramson in a couple weeks' time.
Jes, let's hope it's just not the top of a dirty, great, big bull run in the market, and that's what you're expanding into. Dividends. It's a bit like my conversation with Sergio Amotti. I always get the question with you with dividends and buybacks. Where are we with buybacks, Jes? Can you commit to the market that you will do a buyback in 2019? What's the guidance?
Yeah. Well, one of I think the biggest stories perhaps of this third quarter is, one, we are reiterating that we will pay this year a 6.5 pence per share dividend. That's more than double what we did last year. It's roughly 1.1 billion pounds. But in addition to that, I think very importantly in this quarter, we got approval from the PRA to redeem the last what's called the dollar preferred, that were some very expensive preferred shares issued in 2008. That's effectively returning capital to our shareholders of 700 million pounds. So between doubling the dividend and paying back the dollar preferred in 2018, we will return some 1.8 billion pounds of capital to our investors. And we look forward to doing that and hopefully even more in 2019. So I think we're pretty confident that we'll have a good dividend program for 2019 and look forward to purchasing stock, particularly if it stays below book value.
Okay, Jes, so confident in returning money to shareholders, also, of course, investing in bankers and traders. What about costs? What can you tell the market about your guidance on costs and being confident in reining in those costs?
Well, you know, we're very confident that we're going to hit our cost target. That's what we're guiding the market to. Our costs were well controlled in the third quarter. We've essentially said, costs should be around 13.9 billion pounds this year. We're confident that we're well on our way to deliver that. But I think the important thing, now that we're generating double-digit profitability and clean earnings quarter after quarter, we also want to invest in the bank. So we're investing heavily in digitizing our consumer bank. We're investing heavily in the electronic trading we have across the investment bank. We want to make sure that our customers' data is safe and sound, so we're investing in the resiliency of our technology platform. So we finally have the benefit, as we control our costs and generate the revenues we're generating, to invest in the future, in the future growth of Barclays, and that's what we're doing now.
Jes, let's pivot a little bit to some of the bigger issues. Mark Carney made comments in regards to banks' robustness. They can withstand more than just Brexit. What I want to understand from you, in Carney's synopsis, he models a 35% drop in the housing market over the next 3 years on a hard Brexit. Do you think that that's an overly aggressive call? How perilous or how difficult a position are we in at the moment in terms of planning for a hard Brexit at Barclays?
Well, at Barclays, we are well on our way being prepared for a hard Brexit. We have increased the size of our bank subsidiary in Ireland. We have filed all the necessary applications to relicense our branches across Europe, from branches of the UK to branches of our bank in Ireland. So we're fully prepared to be 100% operational in the case of a hard Brexit. Obviously, the issue, we are a British bank. The concern is around the UK economy. We have been prudent over the last 2 years in terms of our credit standards and our underwriting standards. We have not grown our credit card receivable book in the last 2 years. Our levered loan portfolio is actually down 25% in the last 2 years. And remember, our strategy is to be diversified. And that diversification means that over half of our revenues come from outside the UK, most notably the US. So we feel that we are diversified in our business strategy. We were diversified by geography, by currency. So we feel that we're pretty well positioned for a hard Brexit. But obviously, I think, like everyone, we'd like to see a negotiated Brexit, which does not harm the economy in the UK.
Jes, we've been talking all morning about markets climbing the wall of worry, a fifth day of declines for US equities, volatility in the bond markets as well. Looking ahead to the rest of the fourth quarter, are we going to see a recovery in equities, or is it just more volatility?
I think more than likely we're going to see more volatility, which actually is one of the reasons why our revenues in the markets business are up. When markets are volatile, we as an intermediary in the financial markets do well. That being said, you can't ignore the power and the strength of the U.S. economy. The largest economy in the world is growing. It's got real strength to it. It pulls a lot of the rest of the global economy along with it. So whilst I think there are concerns around valuations as interest rates rise and central banks pull away from accommodative monetary policy, don't take your eye off the strength of the U.S. economy. And my bet is right now the markets are actually sort of setting themselves up for somewhat of a bounce in the weeks ahead.